Hey, Jolene, guess what?
What's that?
We're live.
Totally. Guess what I'm listening to? I'm just kidding. I didn't have time to press play. I didn't have time.
I think I know who you're listening to. Yeah, can you actually believe it? She's actually listening to a song. She's over there getting hyped while we're live.
I have to, because these haters and their slander, like, I can't.
Well, guess who's first?
Reggie.
It was Reggie. How did you know? And then we also had coming in second, Erica Mitchell Bryden. Hopefully I pronounced your last name correctly. And
hey, Erica, what's up, Reggie? Holding it
down.
Good.
You know, there are some things that may be coming to the stage pretty soon. So, stay tuned. What's good, Reggie? All right, y'all. What's good? I'm Mark Monroe, accompanied by my wonderful co-host, co-producer, and good friend, the wonderful
NGC, and the place to be.
Hey, there it is. And this is Hot Take Thursday, a show in which for those of you that may not know, we get to talk about some of the things that are news related that relate to the market, whether it's economics, stock related, or just general based news. And then ultimately is my goal to give you fresh off of the top of the dome without any rehearsal, what is it that my take is, and giving you fresh information. And then of course, if you haven't subscribed, go ahead and hit the subscribe button down below. If you like the video, go ahead and hit the like button. And on top of that, if you want to be in the know or be one of the first people that actually join some of the chats, go ahead and hit the bell so that way you can be in the know, be a part of the notification squad, aka the Cool Kids Club. So, Jolene.
Yes.
How you feeling?
I mean, right now in this moment, I'm good.
Okay.
Ask me at the end of the show.
Okay. All right. Well,
how are you doing?
I am rebalanced after all the dramatics and everything else. I kind of like just treat the haters with, as if it's an unaddressed envelope, and then honestly just focus towards bringing more content. I'm really excited for some of the startup projects that my firm has been, pretty much supporting. And on top of that, I am so excited for June 15th. It can't come soon enough. For those of you that don't know, I will be officially stepping down from venture capital. So that way I can do more as it pertains to helping out with my team at Red Eye Studio. And on top of that, doing more stuff here at the Come Up series to produce more and more content for each and every single one of you, as well as also just having some personal time. So, so excited.
Well, that's cool because, I'm excited too about upcoming projects as well.
Yes.
I'm not going to say too much. I hate saying too much ahead of time, but just know that we are working over here. Like, good Lord. I had a great meeting with Steve this morning, very casual. And, it was good. It was
good. All right. Okay. Well, should be some pretty cool things that are coming out. And honestly, let's just get into it.
Yeah. All right. Oh, do you want to, do the housekeeping? I hate that phrase. Do you want to talk? I don't think you told people what they need to do.
Oh, I did.
You did?
I did.
You said like and subscribe?
Girl, I am rolling today.
Oh, you know what? I was probably listening to something else.
Yeah.
Anyway, all right, y'all. What's good? It's Hot Take Thursday. I'm Jolene GC in the place to be, and super excited to get into this news today. Okay, so we have the Dow coming in at 433.79 points. S&P 500 is at 49.46 points, and the NASDAQ is at 93.31 points, and the VIX is a little over, it's more than what it was last week. It's 23.13 points, and the 10-year Treasury note is at 1.66%. Now, for sector performance, as you know, there are 11 sectors. We track the top 3 and the bottom 3 so we can see what that rotation is looking like. And we have industrials, financials, and utilities. The top 3, bottom 3, we have communication services, consumer discretionary, and energy. More on that later. And for pick performance, you can find our picks at the Come Up series, at that Come Up series on Instagram. And it looks like the chips were leading the way. We're trying to. There was like a little a little baby rally of sorts. We'll see if it holds through till Friday. But
shout out to Lamb Research.
Right. Because Lamb Research is number one at the top, followed by Target. And then Home Depot is making its way back up.
Shout out to Kiki.
Yes. And then, okay, so then for the bottom three, we got Teladoc, Baba, and C-Web. Now, I will note about Teladoc. Teladoc reached its 52-week low today. So that was interesting. We got Disney that had earnings, and we also have Baba that had earnings before the market. Disney, I believe they just shared after the market with some concerns over subscriber growth. And they were talking about how Disney Plus subscriber numbers were low, and then obviously so were Netflix, but the difference is that Netflix charges more, so now they're concerned about profit and all this other stuff. So
I could have sworn I said this a while back. If we journey back in time, where I said, hey, roll, like, where's the harp? Cue the harp. But I remember saying that, hey, those prices ultimately can cause some serious challenges. Everybody will be like completely on board in the beginning, but then at the same token, what they won't like is the fact, and here's the problem where Disney Plus is really struggling. Nobody likes having to be charged $29.99 for a film that's coming out. Why don't you just be like HBO Max and just charge, say, for example, the premium price, and then essentially have that baked in for new releases like HBO Max does. I mean, HBO Max, they're killing it, and ultimately Disney Plus hasn't caught on to that yet. So, and now you're also dealing with the pretty much the law of large numbers. When you get to a certain point, then it's like, all right, you're not going to see such astronomical growth anymore. So
yeah, and I just want to send out a special shout out to my HBO Max sponsor. I really appreciate it, Oh, you know what? No, I would be remiss if I did not shout out a special someone. So today, big mentor energy. Today is Lori P's birthday. Happy birthday. I love
happy birthday.
And then a little birdie just told me that Vanessa's birthday is tomorrow. So happy birthday.
We need to get one with the sound, because I feel like we're missing something. Like,
I know. But when I bought them, I thought that, why would you make them without the sound? That's so corny.
Maybe because, maybe, I don't know. They just don't like, they don't like celebrating.
I was hoodwinked on that.
This is like something that you would like use as a celebratory thing if you were holding like a party in the library or something.
Yeah, like we celebrating. All right, let's get into this Black history. We gotta keep our ancestors at the forefront here.
Okay.
Here we go. Shout out to Brian Clyett. Is that the intro of Black history? Shout out to Brian Clyett. Appreciate you, brother. He's always bringing the news. He is our historian, and he's so good at it. So let's see. Reginald F. Lewis, born December 7th, 1942 to January 1993. He was an American businessman. He was one of the richest African-American men in the 1980s and the first African-American to build a billion-dollar company, TLC Beatrice International Holdings Incorporated. When 6-year-old Reginald Lewis overheard his grandparents discussing employment discrimination against African-Americans, he asked, "Why should white guys have all the fun?" Born in Baltimore, Maryland, Lewis grew up in a middle-class neighborhood. He won a football scholarship to Virginia State University and joined the Alpha Phi chapter of Kappa Alpha Psi while an undergraduate student. After graduating from VSU with a degree in political science in 1965, he took part in a summer program at Harvard set up by the Rockefeller Foundation that introduced African Americans to the study of law. While there, he made such an impression that Harvard invited him to attend school that fall. At the time, this made him the only person in the 148-year history of Harvard to be accepted before even applying. In 1987, Lewis bought Beatrice International Foods from Beatrice Companies for $985 million, renaming it TLC Beatrice International Holdings Incorporated, a snack food, beverage, and grocery store conglomerate that was the most prominent African-American owned and managed business in the U.S. When TLC Beatrice reported revenue of $1.8 billion in 1987, it became the first Black-owned company to have more than $1 billion in annual sales. In 1993, Forbes listed Lewis among the 400 wealthiest Americans with a net worth estimated at $1.4 billion. Here is a quote from Brother Lewis, Reginald Lewis. If you're determined to do the big deal, you better be just as determined to understand the little details. Let me read that again. Let's run that back. If you're determined to do the big deal, you better be just as determined to understand the little details. That's some serious wisdom right there.
That's business.
It's so pertinent.
That's business 101. You know, the other thing that I learned from my grandfather, like who, you know, also like taught me something about business.
What?
Never give ultimatums unless you're willing to walk away from the table.
That's a good one too. That is a good one. All right, so you ready to get into this hot take?
Yeah, but can I give a special little hot take? I feel like I'd be remiss here.
Yeah. Okay, here we go.
Dear Disney.
Let me sit back.
Growing up, we loved watching many of your wonderful special feature films, from Lion King to Aladdin. And then, of course, it's like, you know, you had other stuff that came out, like the Disney TV shows. I really wasn't a huge fan of the Mickey Mouse Club, so that wasn't really my speed. But, you know, somebody else liked it. I mean, yeah, you can't really forget about the jingle. But then you came out with something that was very interesting. And it was like something that everybody thought that was so groundbreaking. That was your streaming service, Disney Plus. Now, of course, I mean, I can't really fully give you like the full arrow of shade because, like, you know, nobody saw a pandemic coming. So I'll give you that one. But I kind of hate to say that I told you so, but, you know, this is one of those ones where it's like, we told you so from us, you know, just from the consumer and maybe a potential could have been investor in Disney, because of the fact that, you know, hey, you were tooting so much about like 100 million subscribers and everything else within the platform of Disney Plus, but yet at the same token, and you threw so much shade at Netflix. But at the same token, it's like you thought that your main key point was just was like pretty much undercharging for the content. You know, one thing I've learned about value is that if your stuff is, say, for example, if you have a premium product that's always on sale, then it's not very premium, is it? And on top of that, it's like, where do you get off by charging people $30 for every movie? Like, for real? You're going to make people charge $30 for a Mulan, but whereas if there were DVDs and Blu-rays out there, they would only be paying like maybe $10 at their nearest Walmart. Or essentially, if it was on, say, for example, on streaming services, then they would be paying, say, for example, anywhere from like $12 on, let's say, Apple iTunes. I mean, come on, let's just really be serious here. You gouge people as it pertains to the cost. And ultimately, that's also started to be somewhat of a hiccup for your service because of the fact that nobody wanted to pay those premium prices. So you mean to tell me if a person is paying a monthly subscription service, that'd be like them paying for, say, for example, a boxing or a sports service, and then they have to pay for, say, for example, you know, an extra pay-per-view. Oh, wait a minute, they did that and it didn't even work with ESPN Plus. And wait a minute, I thought for a second that you also owned ESPN. You would think that you would learn from, say, for example, one of your other parts of your platform, which happens to be ESPN, and which we all know, hint, hint, ESPN is ultimately like, you know, pretty much bleeding you dry. So learn from, say, for example, your mistakes like ESPN and many of the other things. I mean, I understand essentially that you're developing more and more content, and you probably have a dope content library. And let's not forget about the fact that Marvel ultimately carried you for quite some time. Because if we're really talking about it, Lion King was never better than the original. I mean, no shade to Beyonce or anybody else, but it just wasn't better than the original. And no shade towards Aladdin, it wasn't also better than the original. So the fact that you made everybody pay $30 extra to watch something that wasn't better than what the original was, it's like kind of like, well, I'm gonna have Life cereal, which is original, but yet everybody knows that you eat Cinnamon Life.
Oh, Lord, no.
So, I mean, I'm just gonna say this, and you know, hopefully we learned a valuable lesson here that ultimately, hey, maybe, just maybe, it's time to rethink our strategy and realize that this is not the speed. Now, of course, everybody out there is probably starting to relook at things as it pertains to luxury-based items. And Disney Plus, you are one of them, just like, for example, Netflix charges at that premium. Now let's get on that. Netflix does charge at a premium, but they also release content that is one original and also something in which that people can binge watch on and is quite worthy, and they're not gouging them on extra costs. And on top of that, they're not really being Gestapos when it comes to folks like literally sharing their Netflix with a bunch of other folks so that we know that they're cracking down on it. Just saying, maybe you should learn from some of your other competitors out there, because maybe, just maybe, if you learn from your competitors and also ultimately find a better way to maybe better price your product and maybe also come out with better content, who knows where you'll be. Until then, I yield my time. See you in the next quarter.
Yo, you already know I'm probably gonna get a message from Eliana. Upset that you dissing her company, but we'll see.
My grade for Disney is do better.
Okay.
Well, it's not to say that they're bad. It's just do better.
Better.
You could have done better.
Okay, she might be okay with that. We'll see.
Yeah.
Eliana I think she's like 6 years old, and she goes hard for Disney. Her portfolio is Disney, and you can't tell her.
She goes hard at the game.
Yes. All right. So are you ready to get into this hot take or whatever?
Oh, let's do it. As you can see, this is the type of energy that I started with. So rated E for everyone.
All right. So just so you know, on the horizon, we're definitely going to get into the hot take in news, but we also want to talk about some Quad Witch prep. So what to expect, those sorts of things. So we'll get into that like a little later. All right, so let's get into this news. All right, so let's just get the first one out the way. Everyone's talking about Elon and how he's, waffling back and forth about accepting Bitcoin with the whole, it's not, basically he's trying to say it's not on brand the way that it's currently mined. It's not on brand for Tesla, which makes sense, but didn't he realize that beforehand? And it's really interesting that someone can say something and tank a currency in that way. Like, I'm wondering where the stability is, when the stability will pop up. If one person could say something, then it tanks. I don't know. I'm keeping my eye on it, but I'm definitely not going to be bothered at this time.
So just to answer that, so a lot of folks are like, well, doesn't everybody use like fossil fuels and all this other stuff? Now, see, that's not what he's arguing. What he's arguing is the fact that there are fossil fuel companies. So there was a fossil fuel company, I think they're called Greenridge Generation, and that's the name of the fossil fuel company. Now they were doing nothing. Like they shut down in 2009. And then all of a sudden, this fossil fuel company, like literally is using pretty much their plant to literally start mining Bitcoin all of a sudden. So I think that's what he was talking about. And it's like, just think about it. A company just all of a sudden just rises from the dead like the Undertaker to literally just start, becoming a cryptocurrency mining business at a fossil fuel plant that doesn't really kind of like raise any eyebrows.
I got you.
So I think that that's ultimately where he was looking at it, in the sense of, okay, hey, like somebody's got to speak up about this. And especially when you think about the type of energy generation and everything else that's being used and that type of impact that it can have on the planet. I mean, I think that that's where he was trying to draw attention to. But I mean, could he have done better? It's Elon.
Okay. So people are wondering, when I say people, I mean cousins, are wondering what impact is that going to have on the market and also cryptocurrency?
I think that it's going to have somewhat of as you know, the market's really starting to move towards this new standard, which is ESG companies. Like ESG really matters. For those that don't know what ESG stands for, it means environmental, social governance. So essentially, like if you don't have that written into the framework of your company, hence the reason why diversity inclusion has become diversity, equity, and inclusion, and with some form of ESG attached to it. If you really think about it though, that's a major point. That's a major point in which that companies need to be more aware, and investors have already become more aware. I mean, it's really starting to get into the fabric of like whether it's companies or, like investment firms that are saying, hey, we're not going to take you public unless you have better governance, which means that you have more diversity on your board. Or say, for example, what is your environmental footprint? I'll look at Apple and it's zero carbon. If we look at, say, for example, other companies around the board, they're looking to ultimately solve significant social problems. So those things really do matter. And they really matter to investors. And that's going to be the main theme in moving forward in this next generation of investors and investing. And I think that, there's some folks early on that really get that. And I think that, that happens to be Elon Musk and quite a few other people that are out there. So I would say in moving forward, don't be surprised if you start seeing more of these shakeups take place. Now, when it comes to cryptocurrency, that can have a huge shakeup. I think that if anybody was watching cryptocurrency, especially Bitcoin took a huge tumble along with Ethereum and many other cryptocurrencies that are mined, because it's like, all right, well, hey, this has an impact. Now, not only did it impact the cryptocurrency market, of course, Tesla's not exempt since they bought Bitcoin, then essentially they go down alongside with it. So that'll kind of like let you know exactly where that conviction lies. They still believe in it, but they're going down with the ship. And then on top of that, that also sent companies like Square also going down because of the fact that a lot of Bitcoin or other cryptocurrency buying and trading takes place on that platform. So all in all to say, I don't know why Square went down, because it's just a place where people just buy and exchange. But that's neither here nor there. I would say moving forward, this is going to be a hot topic. I think that, the conversation has now gotten started. And we're going to see exactly how many fossil fuel companies do we really see that are actually players in the cryptocurrency space. And then that can really start to open up Pandora's box to see exactly how many people are actually involved in this. I wish we got to a point where it's like, if you have X amount of cryptocurrency, that ultimately you would have to report that to the SEC. And, who knows, we'll probably get there.
Okay. All right. Next question. Thank you for that.
Yeah.
Let's see. Okay, so there's general questions here. Some of these might need a chart, but it's Thursday. But I'm saying.
Who knows?
So the question is, when is the market going to stop going down? Not that we have a crystal ball or anything.
No, right? My guess is that essentially what you're seeing right now, and I have been doing quite a bit of research on this one. And it was interesting when I saw Tesla stock do the same thing. I noticed that, you have some companies that have just pinged their 200-day moving average. Go back for anybody that's seen how a company's moved after it's hit its 200-day moving average, how it trades after that. And another thing is, take a look at the top line from last year's huge dip, and its bottom line and its bottom point, and then draw it to the point to where we are, or draw it to where they start to connect, and you'll start to see that there's been a consolidation up to that point. And I know that everybody's gonna be like, wait, what, Mark, what are you talking about? So
I don't even know why. You could have just, you know what I'm saying? We already know.
I walked right into that, didn't I? And I'm also gonna give some credit to where credit is due here, because shout outs to Noel, who's been paying attention and sitting very deep within the matrix and seeing how the charts move. And he kind of took the magic trick and kept going a little bit beyond and being very scholarly. And let's see here. I'm gonna clear the sheet real quick, so that way, and switch it to that. And then we're just going to go to that, and we're going to remove some things here. We're just going to look at the line chart, and I'm going to get rid of the Bollinger Bands. Actually, I'm going to get rid of the Bollinger Bands. All right. I'll keep the 200-day moving average though. All right. So I'm going to show everybody, and I'm going to do this in real time for folks. So that way we can kind of get some perspective here. So if we do this, right, if we draw from the top line, I think I could draw a better line than that. So if we draw from the top line and bring us all the way to here, I'm going to just draw that there just for the sake of it. And then I'm going to take us from the bottom line and draw us from here. Of course, this is just very, very janky. So just remember that. I'm trying to do it for the sake of time. But if you notice, we're going through a consolidation period, and ultimately it's kind of cool. But if I was really doing the chart though, it's going to look something like this. And then, yeah, pretty much. Yeah. And then drawing it out. So essentially you're starting to get to a point in where you start to consolidate. But if we look at others, and I'm doing this against a NASDAQ composite, but you can do this with, say, for example, a lot of the stocks that have been getting hit. So for example, if I look at, let's say, a Tesla, because a lot of folks have been asking about, like, for example, what's going on with Tesla.
People are asking what platform, is this bar chart?
Yeah, this is just bar chart.
Okay.
So notice Tesla kind of pinged its 200-day moving average. The last time it did that was back in really 317 when we hit those lows of the market. So essentially it's like we're now at that point where we pinged it again on the 200-day, and naturally when a company like normally pings it, then essentially it's like things tend to kind of like go through a rebounding period. Now, of course, is it just a straight line up? No. Clearly, you can see when we pinged the 200-day moving average here, it did the same thing, except that it then went on a run. Now, of course, this is 2020, so take that with a huge grain of salt. But again, normally this is on a 3-year, so it doesn't really make sense. So if I look at it on a 1 year, boom, we've really hit the 200-day moving average. So, and then if you notice, the 200-day moving average had us at, here it actually has us at about 580. So we crossed that line. But if you look at it from a candlestick point, ultimately, we're pretty much there.
All right. Charts on a Thursday. You never know what's going to happen.
Oh, right? That's crazy.
You never know what's going to happen. Okay, so moving right along here. Will the gas shortage on the East Coast be used as a push for more electric vehicles?
Yes, 100%. I mean, the fact that ultimately that you want to see the economy recover, and you want to see people going back to, if you want to go back to, say, for example, like folks actually being out and about and literally stimulating the economy. Well, you can't do that without people being able to get around for transportation. So that creates some problems. And from there, it's like, all right, well, it's really making the case for electric vehicles really being the way things should go. And it's like, all right, well, it's kind of like sucks because we're in the midst of a time period in which that there's a huge shortage across multiple different boards because of the fact that and here's the part that people need to understand here. If we're in, say, for example, a standard recession, this is kind of like minuscule, but we went through kind of like a depression, a very flash depression, where your global economy goes to a complete standstill. I want you to go back and look at when was the last time that the global economy went to a complete standstill. Like, that's not just one country. We're talking about, like, take all of the G8, for example. Take all of the G8. So the top 8 countries in the world, and find out when was the last time that they all came to a standstill at the same time. Now, mind you, it's like, does the economy stop? Yes. Like, I mean, to a certain degree. Like, for example, what we're producing on a GDP level, where we're bringing in and bringing out. Like, think about it. You had ports closed and everything else. Manufacturing had stopped. So to think, when you stop manufacturing for, let's say, a few months, that can impact something going out for a year in order for it to rebound. So now it's like, all right, we're in this point in time where it's like the economy's trying to, quote unquote, roar back, but yet it can't fully roar back because of the fact that, hey, things have become things are scarce, which when they're scarce, it drives up price, which ultimately gives you temporary inflation. So now that's causing problems for a lot of your auto manufacturers and different industries across the board. And so essentially what you're going to have to wait for is for these things to kind of just balance themselves out over the time period. So when you look at it, the things in which that will look attractive will be the things in which that are the infrastructure based. Like, for example, there's a reason why Lam Research, ASML, Applied Materials are outperforming, say, for example, your AMDs, your NVIDIAs, and TSM. Now, TSM to a certain degree should kind of slightly be in that same category since they are part of the infrastructure, but that's neither here nor there. And then it's like, there's a reason why, say, for example, aluminum companies are doing better than, say, for example, the actual car companies because of the fact that they supply.
Mm-hmm.
So, again, you're seeing these things in the short term because of the fact that their price is driven up due to the fact of inflation. But in the temporary, when you see such quick inflation hit, just imagine what the deflation will look like when those things start to deflate, and then essentially people start to rotate back into the actual other players that move and shake the actual sector or the actual industry. And that's ultimately where like retail investors like all of us, and also some institutional money, is kind of like at that period of like, all right, well, you know, do we jump in the fire yet or do we not? Is it ready? Is it not? Like, where do we go from here? And that's where it's ultimately causing a lot of panic on the retail investor side. But as a matter of fact, if anything, it's just more so in the sense that you're going to have this choppiness through the period. And so we just have to wait for these things to work themselves out.
Where is the institutional money hanging out right now?
Institutional money is definitely hanging out in financials. They're hanging out in energy to a certain degree, which I know that I can't wait to give the shade there. But then there's also things like utilities, because of the fact that people are going to need utility. Like if you have gas and stuff like that, that helps power, say, for example, cities. So, you know, those are the basic things in which, like I said, energy, utilities, consumer staples, financials, and industrials. Those are probably the 5 places in where people are hanging out or hiding out. Now, when the spotlight gets shined, and when I mean by the spotlight, when the market starts to catch up, and when things start to say, all right, well, kind of like the coast is clear, do you really think that they're going to stay within these sectors? No, because when you think about what their earnings can produce, can their earnings actually measure up to, even if you're thinking from a value-based investor standpoint, can they meet those levels? Probably not. Now, some of them will, but for the vast majority of them, no. Your banks are non-attractive because of the fact that your interest rates are still crap. So it's like, that's out. When you look at utilities, I mean, we're getting into the hottest, we're starting to go into the hot months of the year. So essentially it's like, will people really be inside? There goes that. Then on top of that, you also have consumer staples. Now, to a certain degree, it's like there's only so much Clorox that a person can buy and everything else. And, you know, we saw how that played out. You get to a point where it's just like, all right, well, you know, those things are more so panicky based. So sooner or later, and the other part is that, you know, a lot of folks are hanging out in the bond market. If you want to get an idea of what caused those yields to spike, go back and I'll leave some homework for folks. Or actually, I'll give an assignment to everybody in the chat. Who was the investment bank that was literally the whale behind, say, for example, the rise of interest rate yields? I'll give you a hint. They're the same company that bought E-Trade.
Okay. All right, so moving right along here. Okay, some of these questions just got answered. All right, so one of the questions is, okay, so TSM breakthrough for 2 nanometer chips for mass production in 2024.
That's dope. I mean, it's interesting now because of the fact that, and I see that people are throwing up JP Morgan. That's incorrect. But one of the interesting things about it is now it's a race between JP Morgan. It's a race between TSM and now IBM. IBM had also announced just about a month ago or about a few weeks ago that they also came out with a 2 nanometer process. Now, grain of salt.
Oh, wow. Okay.
Huge grain of salt, because of the fact that this is the first time that essentially that we're hearing about, you know, IBM's process and everything else, though that they've been in the game for a minute, but, you know, TSM is more trusted. And on top of that, TSM is also sided with the United States as it pertains to expanding its manufacturing process, which ultimately goes up against what, you know, what China, mainland China, wants the Taiwanese company to do, because of course they want to control it. And Taiwan Semiconductor is like, nope, this is what we're going to do. We're going to partner with the United States to ultimately get this effort out and ultimately expand our operations. So I like it. I like it. The question is that who are going to be the players that are ultimately going to benefit from it and who's not.
Okay. Let's see. All right. So this.
By the way, for those in whom that are asking, yes, it's Morgan Stanley. Morgan Stanley was the correct answer.
Wait, what did Steve say? Steve's hilarious. Okay, so the 10-year note, is that what is causing all of this volatility, or is it a perfect storm?
It's kind of somewhat of a perfect storm. I mean, ultimately, a lot of folks, a lot of your institutional money, they follow the bond market. So essentially, when they see that interest rates or interest yields start to climb, then ultimately they realize that, okay, hey, that creates risk for a lot of your growth stock companies. Though that, I mean, really, let's not talk about like some of those value-based companies that carry on X amount of debt. We're not going to talk about some companies that have more significant debt than many other players combined. But I think that ultimately that's a major factor in which that, if you're thinking about institutional money, that's what they follow. Mm-hmm. Now, could it be a multitude of different factors? Yes. Like, for example, some folks are trying to spur the bond market to ultimately force the hand of the Fed, in which that they said, okay, hey, why would we raise rates so fast? That's ultimately putting more pressure on the economy, though that people say that the economy itself is overheating. How can your economy be overheating when you're lacking supplies and resources and everything else? That's not an economy that's overheated. That's an economy that's in desperate need, and that's globally across the board. So I would say, if anything, watch the ECB and also watch the Fed to ultimately be kind of like the guide there. And so far they're pretty much dovish and saying that, hey, we're not going to raise rates. So it's pretty much this push-pull method where you're seeing banks saying, hey, you need to raise rates. Now, of course, banks have a reason for that because, again, that's how they make money. Currently, they're not doing that significantly unless they're trading, and they are. So now it's just like, all right, well, who's going to budge? Banks have already said that, hey, we're not here to budge, so we're going to keep doing this and putting pressure on the Fed. And the Fed is like, okay, hey, well, we're here for the people. We're not here to be influenced by the stock market. We're here to be we're influenced based upon the actual true economic numbers. Some of the economic data that we're getting out says that, okay, hey, that we're here in an inflationary period. And people think that when you're in an inflationary period, you need to raise rates. But what does that do to the American people? And especially a lot of American people who don't have jobs. You still have an unemployment rate that's still at 6%. So at that point in time, it's kind of like the fact that, you gotta just sit back and wait. I mean, that's the biggest thing. Like, in order for inflation to really rear its ugly head or to literally go away, it's going to have to be proven by the economy. And I think that I'm in the camp that says that this inflationary period that we're going through is literally in the short term, because we're nowhere near close to a recovery yet. My projection for the recovery was going into the end of 2020 or going into mid 2022, late 2022, for for us to actually say that we're fully recovered. We're not there yet. And another major piece that a lot of folks aren't paying attention to, though that it's very, very heavy, people need to be paying attention to what's happening over there in India.
Yes. Oh my goodness.
You need to be paying attention to what's happening in India, because you have 1.7 billion people that are literally going through kind of like what we saw what happened in New York, except probably 10 times worse because of the fact of how population dense it is.
Yeah.
That's causing major, massive issues. And of course, it's like, a lot of these folks are working at some of these American-based tech companies, as well as some of the other companies. So that can also pose some issues as well. So it's not just ever one thing, but it's a multitude of things. But the biggest part is people are definitely looking at the bond market, especially if you're an institutional investor. We know that you're looking at the bond market. We see you.
So there was a question about sector rotation and how long that lasts.
Sector rotation can last anywhere from 3 to 6 months. It just depends. Sooner or later, there comes a point in time where it's just, you reach a breaking point in which that, okay, hey, one, we've gained X amount of value during this rotation, and now it's time to rotate to things in which that have been beaten up, or things in which that we feel that have reached a fair value that we would like to take, we would like to buy more into. And of course, it always comes down to risk. Now, institutional money runs at a different type of risk appetite, and it'll be different based upon the different type of shops that you come through. But when we put it all into perspective, I'm starting to get caught up in the phrases. People are making me very self-conscious about that now. So I'm going to have to come up with some new phrases.
You do you, bro. You do you.
Hey, I can only do me. That's it. The biggest part in which that we'll probably see is now that we've seen companies hit their 200-day moving average, and especially when we see 200-day moving average, and then the other part is we're getting to that part of quadruple witching, in which that you see some rotation that's taking place there. And on top of that, it's now a seasonality thing where people start to move to things that are more cyclical. So I think that's where we're kind of creeping up towards. During this time of the year, you start to see a lot more things that are specifically focused towards the tech industry historically, and not very many things industrially or financially or consumer staples or utility wise. It's just that they just happen to be the flavor because of the fact that all the things that are transpiring right now for the economies to reopen. But sooner or later, investors will be like, all right, well, what's the next thing? And we definitely live by a "what have you done for me lately" type of society, and Wall Street is no different.
Okay, so this is a good time to segue into quadruple or witching preparation. So we
it's
have
always funny. Every single quadruple witching, it's like people are like, all right, what's the prep and everything else? Like, what do we do? I mean, here's the thing. Quadruple witching just means that you're going to have X amount of contracts that are going to expire. And so during a period of time, you're going to start seeing more volatility because of the fact that you're going to start seeing more things move. Now, there's something I got to backtrack for folks in which that they need to understand some things. When you have folks that are out there that are playing and this is not saying anybody that's here in this chat, but when you have folks that are playing in ridiculous strikes that are way out of the money and stuff like that, and when you have a vast portion of people that are doing that, we're talking about more than this is way more than 50,000 people or 60,000 people. We're talking about millions of people. Okay. When you have them playing in things that are well out of the money on the put and the call side, it creates volatility. Why? Because when you have that, it's how does that get settled? It takes time for that to be settled, and that puts more pressure on your market makers in order to settle it. So now it's that's why you could be seeing some evil volatility swings on either both the put side or on the call side, because of the fact that you're seeing, say, for example, when those things get cashed in or when they get cashed out or executed, then ultimately those things have to be processed, and it ultimately has an impact on the actual stock itself. I mean, remember, for every contract, there's 100 shares in there. Now, here we go into quadruple witching, where we have 4 different asset classes that are ultimately expiring on the same day, which is that Friday of June 18th, this year. And so here's some things to pay attention to. The volatility just doesn't take place on that week.
Right.
What you see is a lead up, because naturally, if that was the case, then every single hedge fund, every single investment bank, and everybody else is just giving up their strategies. That's not going to happen. What's going to happen is that they're going to be rotating from one thing and going into something else, or going into a different contract. What you're going to see is you're going to start seeing the lead up probably about now, going all the way till June 18th. You're going to start seeing more and more volatility step into the market. You're going to start seeing more volume go through the market as well. And with that being said, it's going to create opportunity. It's also going to create some headaches, but ultimately during the process, it's just naturally just a changeover period. That's really what quadruple witching is where you have a massive expiration on many different asset classes, whether it's futures, options, bonds, commodities, and so on. You see those things expire the same day, that Friday, but most likely people are getting out of those positions leading up to it.
So basically, the phrase "get in where you fit in" applies, because you might be looking at it all goes back to your entry. you know, and what price you're trying to get in at. So if it's right now, if you see your entry price right now versus waiting until, or not right now necessarily, but you know, maybe a couple weeks later, or whatever, or even right now, because June 18th is right around the corner, then
Correct.
you don't have to wait until the 18th of June to get in where you fit
That
in,
is correct.
you know, so just.
It's just a matter of what your trading plan is. I mean, that's where it comes down to. If you have a trading plan, then this is where it's like it's time for you to execute it. If you don't have a trading plan, then this is where before quadruple witching, you just set up a trading plan and figure out exactly what is it that you want to do. I always tell people don't execute without it. So if you don't have a trading plan, sit down, figure it out. If you don't know how to start a trading plan, there's actually a video on trading plans. I think it's on the Getting Started video for the Come Up series. It's under the playlist. I think it's Your Come Up. And that will help you because it's like I kind of walk you through exactly like, you know, explaining to you the different parts of the trading plan. And it's really 7 steps. From there, it's just a matter of you saying, all right, well, now it's time for me to get a little bit more strategic. And where is it that my entry points are going to be? And obviously right now the market's producing some pretty solid entry points for everybody.
Okay. Oh, someone had a question about the futures market. They asked for a breakdown of the futures market and what really goes on and how it affects the market to open.
Okay, so the futures market is ultimately gives you pretty much an early precursor to what to expect from the actual market when it's open. It typically operates 23 hours a day. It has a little hour breakdown. Pretty much, I think it's right after the market is closed. There's like an hour period in which it settles. From there, it just gives you a precursor to what to expect or give you some type of gauge of what to expect coming down the pipeline. Is it a perfect science? It can be, but is anything really a perfect science? No. But I mean, if there is a perfect science, then the futures market would probably be the closest thing in which that you have. So if you want to track the S&P 500 and getting a good gauge for what the S&P 500 would do, then you would definitely look at the ES, which is the S&P 500. If you want to look at an early gauge of what the NASDAQ could do, then you would look at the NQ. And that will give you somewhat of a good gauge as it pertains to what the futures, what the pre-market or what the aftermarket, you know, aftermarket activity kind of reflects futures market. And ultimately from there, you'll be okay. I think we need to do a more in-depth episode on futures to like give folks an understanding. I don't want to step on Mr. Ian Dunlap's toes, but you know, we'll just give it there just as a precursor to everybody, just a simple overview.
All right, sounds cool. Here's a question. What market moving economic indicators should we be paying attention to next?
I would say look at the manufacturing, because really the actual economic indicator that I really care about the most is really where it comes to GDP. Not really towards inflation, because ultimately inflation is temporary, but GDP actually matters because it lets you know what the import, export, and also what the cost of things to produce was. So it takes everything in totality. So, you know, honestly, that's one of the things I look at. So when I look at PMI for manufacturing, that's something that matters to me. When I look at unemployment, that matters to me. When I look at, say, for example, farm reports, I can get a good idea for that as well. Yeah, so I would say like, and also just GDP, like that's a good gauge because I think that GDP is scheduled or slated to be anywhere between 6 to 9%. We could do better, but ultimately we're coming out of a pandemic. So
now with our upcoming, you know, tax date and people paying their taxes and all that, their question is, does there look like there's going to be, what do you think? Can we expect a slight uptick in tech by the end of May?
It's possible. I mean, given that we've extended the tax deadline, I mean, I wouldn't be surprised if we see like folks that were selling off to ultimately get cash, you know, for any capital gains tax in which that they're going to incur. Because here's the thing, most folks out there, they trade from brokerage accounts versus trading out of retirements. You know, a lot of folks haven't picked up on that secret yet. So they trade out of brokerage accounts like Robinhood or any other platforms, no shade to them or anything at all. But they trade out of brokerage platforms and they go in and out on positions, trade weeklies, monthlies, or whatever it is. And then ultimately, when they make X amount of profit, especially when you made X amount of profit during 2020 and you cashed out, those things are going to be calculated as capital gains tax. Now, when you take your losses, that's capital losses. So you can kind of like offset a little bit. And that can work towards your tax liability. But the biggest thing is that a lot of folks, they made a lot of money with all those returns. We're talking about hundreds of percentages of returns or thousands of percentages of returns. Now, depending on where you're at, depending on what your tax bracket is, you'll kind of get an idea and gauge of what your capital gains tax is. But ultimately, I mean, that's really what you're seeing. You're seeing a lot of folks really getting prepared for that. Now, I could put my tinfoil hat on. I wouldn't be surprised, if certain folks are out here getting, making their marital plans take place, just so that way they can avoid, say, for example, such a heavy tax burden.
Okay, Uncle Billy. All right, so we have some questions here. This one is more so about a potential bear market. This particular cousin would like to know, are there any strategies or tips besides hedging, puts, that sort of thing?
Go cash or go somewhere else. I mean, when there's a bear market somewhere, there's a bull market somewhere else.
Okay.
So you can either go cash, or essentially you can, if you don't want to hedge, then look towards something else in which that is ultimately you're seeing a bull market opportunity, and essentially play that.
All right. Let me see. Do we get all these? Oh, let's see. Oh, there was a question about, where did it go? I just had it. It was about the potential for Microsoft to lose that Jedi contract. I thought it was a done deal.
It was a done deal, but now it's under investigation based upon the process of how that deal went through, and also how it was accepted for the contract. Though that honestly, it's like, okay, well, I mean, $10 billion is something significant when you think about it over years worth of time. It's not like they just get the $10 billion that year. So, I would say, like, honestly, it's like, it's speculative right now because of the fact that they're still in investigation. Here's how it can go. If it doesn't work out for Microsoft, then what they'll probably do is reissue a bidding process, and then essentially they just have to rebid for the contract.
But that opens the door for Amazon to try and get in.
Well, it really came down to Amazon and Microsoft. So, I mean, who else is it going to go to next?
If I was Microsoft, I'd be so mad. Like, yo, we already did this. What y'all doing? Okay, so here's a question. Why aren't clean energy companies in the energy sector, but only in technology?
Well, because they're considered new technology.
There you have it.
I'm just waiting on the part where I can throw some more shade at another energy company.
How long are you waiting?
I'm patient.
All right. Okay, so that was like the majority of, hold on, let me make sure. That was the majority of the question.
Somebody said, if the feds regulate crypto, will crypto crash? I mean, depends. It depends upon if they find out whether or not they're legitimate or not. Some cryptocurrencies will be legitimate, some will not be. You're seeing cryptocurrency creep up in the aftermarket probably right now, or especially probably like some like coin by the name of maybe Dogecoin going up because of the fact that probably Elon said that he's working with the devs at Dogecoin to literally, see exactly like, if they can fix their transactions or ultimately improve their process and possibly make that as an alternative to Bitcoin, and people buy their Teslas through Dogecoin.
Okay.
It's amazing how, Ethereum is not in this conversation, but that's a whole nother other.
I'm looking at the comments. I be trying not to look at the comments because it'll just have me laughing the whole time. But it is entertaining. Like sometimes I'll go back and just look at the comments and crack up with my friends. Like y'all are hilarious. Okay, so we got we're about to be at it's only May 13th, so we have a couple of Tuesdays and Thursdays left in May. What should we be doing as far as because we're getting ready to go into summer, and I don't know if that old adage of go like the whole sell in May.
Sell in May, go away. So where do people go on vacation?
Mm-hmm.
Where are they going to vacation to? Okay.
They're not, but the question
where are you going to go if you don't have gas?
That's a good point. I mean, for those that drive gas guzzlers, yeah, that's a good point. So okay, if we're getting ready to go into summer, so we got Quad Witch, a new set of Quad Witch. So those of you that are doing rolling fours, you got Quad Witch coming up. Butter is just chilling. And summer wise, and I'm just thinking more like research. Where do you think people should be looking towards or like getting more information on?
As it pertains to?
As it pertains to, like, we're getting ready to go into the second half of the year, and usually during the second half, it's like, second half adjustments, so like what should we be looking towards?
Well, currently what you're going through right now is we're still in earnings. So that's the other part. We're still going through an earnings period. And honestly, it's like, people still do vacate. Like they will go on vacation. And I think that the biggest thing is that it will create a buying opportunity for some, and then for others, it'll create a selling opportunity. So you'll get somewhat of a mixed bag depending on the type of company or the sector. Where you should be looking at is, of course, look at the historical part of the charts. So essentially, people say look at the Stock Traders Almanac. You can do that as a good data point, so that way you can look at that and compare it towards what's happening. Another thing in which that you can do is look at you can look at really like I said, look at charts over a 3-year span, because that gives you kind of like a good place. If you want to look at it over 5 years, you can do that too, just to see exactly how, say for example, things trade from May through July. That's a good marker, because you'll start to see some trends and you'll start to see like recurring behavior. I would also say, really look at, the economic data. The economic data in this year is going to have a huge impact on how things move going into the second half of the year. It is my opinion, just my opinion, y'all, that I think that as we move into the second half of the year, we'll start to see some of these things start to subside. And then ultimately people are going to have to really make a decision. And I think that second half is coming up very, very quickly, where people are going to have to make a decision on, hey, have I gotten enough, beta in being in these positions? And am I really missing out on an opportunity that's somewhere else, or somewhere else that's something that's tried and true? And as we move out of this phase of quote unquote inflation, that's the first thing.
Okay.
Another thing to look at is, say, for example, the S&P 500. So I made a bold claim earlier on, I'm making a bold stake out here with, when I make a stake like that, that's my reputation on the line. So I'm staking that by pretty much 2023, that we'll see the S&P 500, mid 2023, we'll see the S&P 500 at 5,000. Now, in order for us to get there, you're not going to do it off of the back of financials, energy, utilities, industrials, and consumer staples, because by that time, that story will be over. So now it's going to be a new story, and people are going to have to go back and look at the drawing board and say, okay, hey, what's really going to get us there? And you'll start to see that towards the latter part of the year, where we start to see that correction take place within the S&P 500. And with that correction will probably be a correction / rotation that takes place all at the same time. So just wanted to put that out there for perspective for the people. So those are the things to really just be watching. Also look at a lot of the, if you can, get a hand on some of the research out there by some of your favorite analysts, or from the analyst research reports, and look at it across the board. Don't just look at the company, but look at what some of the things in which that they add in as it pertains to risk factors and reward factors, as it pertains to economics, as it pertains to what's happening in current market situations. Those will be a huge help to you. Like, let's not forget about our analyst research, because it's there for a reason. And then on top of that, stay tuned, because we may be having a round 2 with our friend from Loop Capital, which I'm hearing should be taking place in the beginning of June with Mr. Anthony Chikumba from Loop Capital. So that's going to be interesting too.
He was a joy. That's hilarious. So it's 6 o'clock.
Yep.
On the dot. Don't worry, y'all. I saw some questions that are more Trade Talk Tuesday type questions, so I'll make a note and we'll bring those up for Tuesday. So if we didn't get to it and it was a Trade Talk kind of question, we'll get to it on Tuesday. So don't worry about that. Is there anything you want to say before we go? Because I'm trying to get out here in these sunny streets.
Yes.
Appropriate.
Ladies and gentlemen, there's a few things that I must get off my chest. Now, first, I'm going to start it off and preface it with, I feel like I'm rocking, what I'm feeling right now. If you have influence, you have a responsibility. So I feel like I have a responsibility. So first things first, let's look at one specific energy company, a pipeline company. Now, this pipeline company suffered a cyber attack. Now, I don't wish that upon anybody, so I don't want anybody to go out there and be like, hey, Mark, is all for anarchy. No, that's not me. If you think that, then that's not my speed. And honestly, you need to go talk to someone quickly. But it really speaks to you to let you know exactly how far behind technologically a lot of these platforms are. It's like when you think about it, an energy company, which brings in billions of dollars a year, couldn't take the necessary precautions and pay the money for the dope tech that would keep their pipeline safe from cyber malware or cyber attacks. And then, I get it. You try to exhaust every single opportunity that you could. And I think that somebody's going to, the poop is going to roll downhill to someone. And ultimately, it's going to be bad because of the fact that they literally choked and said, you know what, we can't solve this problem because we didn't make the investment in our technology sector to keep us safe. And so now you paid a ransom of $5 million to a hacker group just so that way you can release the energy. Now, the question is, my question is when this happened, I'm probably sure that there are a ton of other energy companies out there, and other pipeline companies that are out there that are ultimately saying, all right, well, we need to look into this fast and look at our cybersecurity and also figure out exactly how is it that we can bring our company or our infrastructure to the 21st century. That's kind of twofold because one, the industry needs it. Two, essentially that also introduces other players that we already know of that are well in the cybersecurity space and well into cloud infrastructure space. So that way we can have things much more faster and much more secure. Step in. So now it's interesting. It's very, very interesting because now it's like we're seeing that a world we're in, and no shade to all of the cousins out there that drive internal combustion engines. But what I wanted to say is that, this right here is the reason why that it's starting to prove thesis for the future is already here. And the only thing that you have is big internal combustion engine companies and many other oil and gas companies that are trying to literally stall the inevitable. The inevitable is coming. So I'm not saying that it's going to happen this year. I'm not going to say it's going to happen whenever else, but I just know this, sooner or later, it's going to come. And for anybody that doesn't understand ransomware, it is no joke. Ransomware has held hospitals hostage in which that people needed care and they couldn't because people were locked out of the system. Let that sink in. Ransomware is not a joke to be played with at all. So then there's another part where we got to look at it from the standpoint of this. Now, to those out there that understand that ultimately that, hey, like shout outs to all the cousins out there that have supported myself and Jolene throughout this entire process. Like we said, it's not easy doing this. If you think that this is easy, go start a channel. I'll be one of the first people to come and watch your show or watch your channel and ultimately give you kudos. But just to let you know, when you stand on the stage and also when you're doing this, like there's a lot of heavy duty criticism that comes your way. And the difference is that essentially it's like we don't charge you a single dime. No shade towards anybody else out there that does it. Hey, that's what they do. Keep doing it. If you bring value to people, keep giving them value. But we do this because of the fact that we just love it. And for those of you that are afraid is like, hey, are we going anywhere? No, we're not. Chapter 2 has now started. We are now in a new chapter, AKA the next episode. So essentially for those out there that are getting frustrated based upon what your portfolios are, we hear you, we understand, we empathize, because at the same token, we are just like you. Our portfolios are getting hit. If you think that we're doing a pump and dump, if you think that essentially that we're pumping and dumping stocks and everything else, that would mean that there would have to be billions of dollars in order for things to move and also for them to go another way. I'm sorry, Mark Monroe doesn't have billions that sit behind his name yet. Jolene, I mean, I don't know. You may be out. So
Not
all
yet.
that to say, it's like, it's instead of looking at us and instead of like getting the trigger fingers to type things on Instagram or on Twitter and everything else, go back and refocus and say, you know what? Hey, this isn't working. There's tons of things like, for example, if you're still like, on ARK or on AMD, look towards other areas. You got the S&P 500, the SPY. You also have many other players that were in the 37 SIP list that are doing well. If you look at FTNT, they've been on a great run throughout this entire ordeal. If you look at TBT, when interest rates go up, then or when the interest yield goes up, then you see TBT climb. When you look at financials, when they're doing well, you got JP Morgan doing well. You got Visa, MasterCard. And so far, tech has been holding pretty heavy as it pertains to XOK and XOY. Go back to the parents for the long term. So if the position is not working, then ultimately what you do is you just step back. It's okay to take the loss and ultimately come back and find something else. Readjust your strategy. One thing that doesn't help you readjust your strategy, throwing shade at other folks, literally talking a bunch of mess in the comments and everything else, trying to discourage myself and Joe Lynch, or trying to help you out. It doesn't do anything. And ultimately, it's like, it's not helping you. And if you think that it helps you feel better about yourself or about your portfolio, you're sadly mistaken. I'm only giving you this advice because of the fact that I want to see you do better. And I know that you can. So it's like, we've rebalanced, we've taken a break to relax. And I'm just going to say this, and moving forward, for those out there that are ultimately tripping, grow up. We're all adults here. It's like, my name is not on your portfolio, just like your name is not on my portfolio. Like I hear about your losses. You don't get to hear about mine, but if you want to hear about one of my losses so far right now, when it comes to my portfolio, I've literally dwarfed the 18. I've dwarfed the 18. Do you see me sitting here like literally like, playing, a sad face or anything like that? No, because at the end of the day, I've been here before. I've been down this path before. And I know that nobody ever gets better by just doing things on a consistent basis. If you were always winning at 100%, then that would mean that everybody out there in this market would be winning. And I remember saying this a while back, in order for some to win, or in order for us to win, somebody's going to have to lose. And there's going to be moments in time where we lose, and ultimately sometimes somebody else on the other side wins. The goal is that it's about portfolio management. And in good portfolio management, if you're playing something in which that is leverage, make sure that you have it leveraged against something in which that is long-term. And if you don't do that, you can't get mad at me. The only person that you can be mad at is yourself. And this is the focus in which that we get better. Because now that we've just had this conversation, like I said, we're on to the next episode. So let's get better. Let's do better. We'll do our very best. And ultimately, there's going to be times in which that things are not going to work out. Sometimes the things in which that we discuss, or sometimes the strategies in which that I let you know that I'm playing, I'm going to lose. But at the same token, it's like, I look at it like this. When we go back and look at all the things in which one of the things that keeps me grounded is for everything that I lost, I consider that as gain, because of the fact is I learn from every single loss that I've made, and it's only made me a lot stronger as an investor and as a trader. Just remember that. And that's the knowledge, that's the wisdom, that's the experience in which that I gain. So instead of like, like they say, don't try to time the market, it's about spending time in the market. And that time that you spend in the market, you learn a lot about the market. And on top of that, you learn about yourself. You learn about exactly what your risk appetite is. You learn about, say, for example, what are the areas in which that you like to invest and what areas you like to venture into, and what are the areas in which that you're like, hey, it's not my speed. And that's okay. The goal is that our focus is to give you the knowledge, to give you the information. We're not here to give you a bunch of entries and exits and all this other stuff. That's not our play. Our goal is to just give you the knowledge, and that knowledge becomes tools. So in moving forward, like, let's do better. Let's be better. Because honestly, it's like if our ancestors came back to literally see exactly how is it that we treat one another, we'd be up in arms. If your portfolio was sitting in your 401k and the market was down, would you be cussing out, say, for example, your brokerage firm? Probably not. Would you be sending death threats to your brokerage firm? Probably not. It's unnecessary. Let's do better. I yield my time.
Well said, Mark. Well said. I echo everything that you said. And someone asked, is the cookout still on? Yes, the cookout's still on. What? It's still on. 2022 though, y'all.
Oh, by the way, so I've restarted the burner account, Jolene. Mm-hmm. So Agent Smith is now dead because of the fact that there was a lot of donations that were left off. Mm-hmm. So I've literally restarted the portfolio, and now we're restarting.
Okay. Exciting.
Yeah.
Yo, but honestly, like for real, I feel like burner accounts, plays, I feel like we should just keep it to ourselves.
At the end of the day, it's like, I'll leave it alone.
Yeah. Seriously, because
I only use the burner account just only for a lesson for everybody, so that way they can gain knowledge in the process, not for them to literally copy exactly what I'm doing or anything like that, but just to gain knowledge. That's the purpose.
Yeah, but I'm saying, like, I feel like that gets to go dark 30, because it's just not. It's not worth it, Okay. It's not worth it. So, but yeah, I think obviously like extracting the lesson, sure, but that level, I just feel like too much has happened, and there's been a breach, and there's been a line that's been drawn, and it is what it is, and I just feel like we get to move forward and focus on the mission, and hey, I mean, certain things just have to be this way. And you can say I'm hating if you want to. Yo, it is what it is. Like, there's just certain things, like, legit, like, just cannot be tolerated. Just period. It just can't. So that's how I feel. That's my truth. That's my story. And in order for us to, keep doing this, I feel like there's lines that get to be drawn, boundaries that get to be reestablished.
Yeah, I mean, like, I respect my wife 100% in the sense of and I follow her leadership and her tutelage. Shout outs to you, Erica, because honestly, my wife sits in the dark, in the shadows, not putting herself out there in the public sphere of anything. And for her to come out there and say what she said or what she typed, that was huge, and it made me go back and reevaluate. Mm-hmm. And so for me, it's just more so in the sense that, yes, my wife wields the sword or the gauntlet to say, hey, if she pulls the plug, Mark I fade to black.
I'll still be here, y'all. I will, because I'm not going anywhere.
Yeah, but so far I'm not going anywhere either. It's just more so in the sense that, like I said, we just got to be at a place where it's like we treat each other better. We also, I'm not looking to cancel anybody or anything like that. That's not my speed. It's just more so in the sense that we just correct each other as a culture, and ultimately be there and support each other as a culture. But at the same token, it's the biggest thing which is respect.
Mm-hmm.
So, like I said, the shirt, shout outs to the folks in which that, sent me the shirt. I mean, it really spoke to me. If you have influence, you have responsibility.
Yeah.
And so we have a responsibility, which is to teach and to share the knowledge with each and every single one of you. The only responsibility that you have is to ultimately be accountable to your portfolios, and also to give that same energy and respect that we give to each and every single one of you. That's it. Outside of that, Jolene.
Yeah.
That's what I'm about to do tomorrow.
What?
I'm going to go get my second dose of my vaccine tomorrow with my wife early in the morning.
All right. So you're doing that early in the morning, right?
Yeah, because we got class.
Yeah. Yeah, we have class on Friday for the high school curriculum project.
Yes.
Which is exciting. And I can't wait until they're, they've gone through the whole curriculum, and we can share that experience with what they went through. And that's going to be exciting.
Yeah.
But yeah, like I said, y'all, we're not going anywhere. There's so many projects that are coming down the pike that I know you all will be excited about and pleased. But yeah, we're definitely,
we out here.
Yeah, we're out here, we're readjusting, and it's all good.
All right. Well, until next time, I'm Mark Monroe.
And I'm Jolene GC, and the place to be.
And this has been a come up on Hot Take Thursday. We will see y'all next week. Have a good one. Be kind. And on top of that, keep studying.